Well, as I'm making this video, the stock market just continues to be a mess. Just on Friday, most popular retail stocks were down another 5% or more, and it appears like there's no end in sight. In fact, with lots of growth stocks right now, we haven't had valuations this low in almost a decade and a half. And it's just crazy how quickly that switches, because the argument not long ago was that most growth stock valuations were stretched way too far up. In the community, there appears to be one common issue. I see a lot of people saying they are running out of cash to buy the dip, or they are just flat out of cash to buy the dip because they've been buying the dip, but the dip keeps on tipping. However, what you may not realize is that there are actually some strategies that you can utilize to take advantage of the dip, even if it keeps on dipping, if you're running low on cash or if you're out of cash. In today's video, I'll be going through 5 different strategies you can utilize, and chances are at least one of them will be helpful to you. All of this being said, as usual, I will include some timestamps so you can skip ahead in the video. If one tip isn't helpful to you, you can go right to the next one and skip through the video without wasting your time. And with that, if you guys are new here or returning by chance and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. And if you appreciate this type of content, feel free to hit the like button. And if by the end of watching this video you were helped out in one way or another, feel free to share this video with other retail investors that might be interested in using some of these different strategies. Without further ado, I'm going to waste no more of your time. Let's go ahead and get into this. The first strategy I'm going to talk about that can help you in times like these when you're running out of cash is something that I call concentrating your portfolio. Basically, selling out of your less confident plays in order to buy more of your higher confident investments. Also, if by chance you're selling losing investments when utilizing this strategy, you'll be able to offset some of your capital gains by selling those. And that is very advantageous because nobody wants to pay tax. Typically, this is a very high risk, high reward strategy. For example, you wouldn't want to do this if the stocks were at highs, because if stocks are at highs, you want to spread out your risk so that you're not subject to 1 or 2 stocks going down and therefore tanking your portfolio just because of those 2 stocks going down. However, in times like these, when stock valuations are so low, this is the time that a strategy like this could really pay off, and there's really limited risk in utilizing this strategy when the stocks are down. And by concentrating your money into your highest conviction plays, your portfolio will also scale up much faster because you own more shares of those high confidence plays rather than owning fewer shares of more stocks. So with this strategy, there are multiple advantages, such as writing off some capital gains potentially, and also scaling your portfolio up even quicker. Moving on, strategy number 2 is quite obvious, and it is to go into margin. Now, I don't recommend doing this to anybody unless you are a grounded individual. And the fact of the matter is, most people misutilize this tool. Most investors will utilize margin when their stocks are at highs rather than when they're at lows. And by utilizing margin when your stocks are at highs, you get subject to margin calls when your stocks dip. What most people get mixed up is the best time to actually utilize margin is when your stocks are at lows, especially in a low interest rate environment like we're in now. And if you choose to utilize margin, you won't have to sell other stocks in order to buy additional shares of stocks you love on a dip. However, if you do utilize margin, I would highly recommend, as the stock prices rise back up, you pay off and cover that margin debt. Strategy number 3 is a little bit more complex, and it's where you sell call options. When you sell call options, you get paid cash up front, otherwise known as a premium, for putting your shares up for sale if the share price of the respective stock hits a higher price. If that higher price is not hit, you get to keep your shares, but you also get to keep the cash that you're paid up front or that premium money. So basically, if the higher price isn't reached by the expiration date of the call options, you get to keep all of that cash you were paid up front, and you also get to keep all of your shares. You don't have to sell them. I would advise using this strategy if you own stocks like Enphase, AMD, Nvidia, or Tesla, just stocks that have done pretty well despite what the majority of the stock market has done, which is go down. Worst case scenario, if you sell call options and that higher share price is reached by the expiration date, you have to sell your shares that you own at a premium. And that in the end just gives you more cash to pile into the beaten down stocks. If you own some stocks that have done pretty well, you'll get paid quite a bit of cash and premium up front because people are making bullish bets and buying those call options, betting that they will hit those share prices down the road. However, you can take advantage of this and sell them those call options for a massive premium. Strategy number 4 also utilizes options, and this is where you sell puts. However, there is a caveat for this strategy. You need at least some cash in your brokerage account to be able to utilize this. When you sell puts, you receive that same cash or premium up front by giving another person the right to make you buy shares of a stock at a lower price if the share price falls beyond that point. Again, you're going to need some cash in your brokerage account to cover the possibility of being forced to buy shares of a stock at a lower price. It's pretty intuitive, but if the share price of the respective stock doesn't end up falling to that share price where you're forced to buy shares, you just get to pocket the premium or the cash you received up front. However, if that lower share price is hit, you keep that premium and cash you were paid up front, but now you're forced to buy those shares at the lower price because you agreed to do so when you sold the put options. So worst case scenario, you end up buying shares at a discount of a stock you want to buy anyways. In best case scenario, you get to pocket the premium and cash you were paid, but you're not forced to buy the shares because the share price doesn't fall to that price. It's the same concept here. Right now, people are paying massive premiums to buy puts. And you can be on the other side of this transaction and sell them those puts for a massive premium because there's so much interest in buying puts right now. All right, so finally, the last strategy you can utilize is strategy number 5. And it's called go out and work. It's obvious, but some people don't want to do this. But let me tell you, if you are willing to do this, you're going to be successful. There are so many different jobs out there that you could do to make several $100s per day. This includes picking up leaves, scooping snow, hanging up Christmas lights. You can get paid several $100s per day. And when stock prices are depressed like they are right now, several $100s a day can go a very long ways. Think about it. Your favorite stock right now, you would probably argue, has a legit chance to at least 3x from here. So think about it. Every $100 you earn from doing extra work like picking up leaves, scooping snow, or hanging up Christmas lights could turn into $300 or more. Say you do this for a week and you average $200 a day. That's $1,400 in 1 week. That could turn into $4,200 over time if your price targets on your favorite stocks are actually reached over time. Right now, lots of stocks are on discount. I don't need to make a video explaining that. I think everybody watching this video probably understands that. And if you're willing to do work that other people aren't willing to do, you're going to be successful in anything you do in life. And investing is no exception here. Anyways, if you guys enjoyed this video, please hit that like button down below. If you know somebody that this might be helpful to, please share it with them. And again, last but not least, if you guys are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. With that, I hope you have a great rest of your day. I'll be back with a brand new video later this week. Peace out.